We could reestablish the American industrial might in 10 years if we reformed the tax code to make it once again investment friendly as opposed to consumption friendly. What we have decided to do in the United States is to steal money from people who generate wealth to distribute it to people who consume wealth. All admirable, something that curries the favor of the people who consume more than they generate, but not the way that you establish industrial capacity. You raise workers' wages, and real wages have been in decline in the United States for 35 years. You raise workers' wages by educating them and allowing them to employ more capital.
We have this initiative to bring on like manufacturing, to bring industry back. We've had multiple issues with the rare earths and such. I mean, now you have silver, copper, and many other minerals that are put on the strategic minerals list, critical minerals list, and such. And then you have the government that are actively investing in private companies, taking stakes in private companies and such. And so, I've been kind of thinking about that, like, okay, how much of this is like going to come to fruition? Because it seems like it's going to take years and decades to even build out, as the Chinese have been building their infrastructure for a long time. And so curious if you have any thoughts there.
If I was to be charitable, Daryl, I would say it's well-intentioned fraud. But I think it's worse than that. I think about myself as an example. I've been investing in natural resources and critical metals now and energy for 50 years. I don't think that Trump is a better steward of my investment capital than I do. I don't think I need him as a money manager. I think if you took the 16 elements that compose the rare earths on the periodic table as an example, that Mr. Trump couldn't spell any of them. So the idea that he's going to invest my money for me is something that I object to rather strenuously. In terms of the dearth of investment in the United States, I'm not a politician, I'm not an economist, and I could solve the problem beginning tomorrow. Literally beginning tomorrow. Let me explain. The U.S. tax code is consumption friendly, not investment friendly. If you and I were to build a mill in socialist Sweden, the tilt-up concrete building that we would build to house the mill, we would expense against our taxes in year one. In China, we would expense that in year one. In Russia, we would expense that in year one. And in the United States, we amortize it over 33 years. Guess where you build the factory? I don't want Trump to give me money. I want him to leave me with my own money. We could reestablish the American industrial might in 10 years if we reformed the tax code to make it once again investment friendly as opposed to consumption friendly. What we have decided to do in the United States is to steal money from people who generate wealth to distribute it to people who consume wealth. All admirable, something that curries the favor of the people who consume more than they generate, but not the way that you establish industrial capacity. You raise workers' wages, and real wages have been in decline in the United States for 35 years. You raise workers' wages by educating them and allowing them to employ more capital. Think about the difference between somebody who operates a front-end loader and somebody who digs ditches with a pick and a shovel. The guy who operates the front-end loader operates a $750,000 piece of equipment, but he replaces 100 or 150 pick and shovel workers. It is cheaper to employ the machine operator at $40 an hour than it is to employ 100 pick and shovel workers at $7 an hour. You restore America's industrial capacity and competitiveness, and you restore America's wage rates by changing the tax system in a way that aids capital formation and allows American industry to allow its employees to employ more capital. It's as simple as that. Politically, that's extremely unpopular. What we would rather do is eat our cake than have our cake. The consequence of that is that we're coming into a period of time where cake becomes very, very scarce.
So just thinking about gold in this picture, obviously as the dollar continues to be devalued based on the money printing, excessive spending, M2 money supply. I mean, we even have the Fed cutting rates as well as pivoting on some of the quantitative tightening and injecting some liquidity into like the repo market and such. And so it just seems like a recipe that this train just keeps going. And I'm thinking about gold in terms of like where are we headed with that? So like, because I obviously continue to store my wealth in gold, continue to buy, save in gold and such. Even in our state, they just implemented a tax on the purchase and sale of gold and silver, which is interesting because gold and silver is money in the Constitution, and so they're taxing money, which is interesting. And so I've even found kind of my ways around that. And so just curious in your perspective on gold and where we go from here.
I think gold is a must-own asset, and I wish I didn't have to say that. Gold has served its purpose for at least 1,000 years, but likely longer, as being both a medium of exchange and a store of value. Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. We've already talked about why people need to be concerned about that, because there's a guarantee that your purchasing power in fiat savings instruments deteriorates. With gold, at least you have a chance. And it has evidenced itself as a superior store of value for at least 1,000 years. Importantly, too, with the advent of technology, gold is becoming at once a store of value and a medium of exchange. And let me explain. When you, Daryl, go to buy physical gold at a dealer, whether or not it's in the state of Washington or not, you're probably paying a 3% premium on the buy side and a 3% premium on the sell side. In other words, your transaction cost is 6%. But increasingly, with the availability of digital coins representing gold deposit receipts at places like Tether and elsewhere, you will be able to do that same transactions for fractions of a percent, which means that you will again be able to use gold as money. You'll be able to go to Starbucks and buy a cup of coffee in gold. And Starbucks will be able to aggregate all of those fractional payments and, if they wish, surrender those coins for physical gold, which means that gold increasingly in the future will be at once a medium of exchange and a store of value, which is another reason why I think you have to own gold. On the one hand, to defend yourself, and on the other hand, as a recognition of the fact that gold will once again fulfill a role in society that it hasn't fulfilled since the 1800s, which is to say, simultaneously a medium of exchange and a store of value. It's very difficult for me to understand why a rational human being wouldn't have a substantial gold portfolio.
So you bring up an interesting topic because for me, obviously the Tether has the coins. It's pretty much like a tokenized gold where you buy a token and you get a right to like an ounce of gold or whatnot. Obviously that introduces like another level of counterparty risk. And for me, like I've been thinking about risk in a lot of ways because one, I had too much metals in my home, and so then I opened a depository, and so then it was like, okay, I need to spread some of this risk out. But then even thinking further, like maybe I spread some more risk out with some of the tokenized gold, such as Tether or some of the other services that sell those. And so just curious in your perspective on diversifying the risk of your gold holdings. I mean, I haven't even got to the point where I'm thinking like overseas and such. I mean, that's kind of like another level to it, but just curious in your perspective there.
You have to assess risk and reward as it applies to you. I'm delighted that you no longer have physical metal in your house, Daryl. there's a different risk there. That is that you would be invited by somebody who you wouldn't normally invite over for lunch, somebody who was carrying a pistol. So I'm delighted that you obviated that risk for you personally. I think you and I talked about that in the past.
Yeah.
One needs to familiarize yourself with the Tether product. My understanding is that the Tether product is not 100% backed by physical gold or silver, although I don't need to know that to be the case. If you are concerned about if you're willing to own a gold surrogate as opposed to physical gold, if you want to lower your transaction cost and not have to be worried about physical storage, there is always disclosure of conflict of interest. The SPROT product. The SPROT product is 100% backed by physical. Institutional holders can redeem their trust for physical units, which reduces and often eliminates the arbitrage. In other words, makes the underlying security track the gold and silver price much more efficiently. And the transaction costs on the New York Stock Exchange are de minimis. So the first level of risk reduction, if you want to obviate the transaction cost, the storage cost, and the insurance cost, is probably the SPROT product. I am, as I say, unfamiliar with all of the specifics around the Tether product. I am unsure as to whether the Tether stablecoin is 100% backed by physical gold or silver, and whether or not one can surrender the XAUT for physical gold or silver. If that feature isn't present, either Tether will add that feature or somebody else will create a coin that will allow you to do that. Mm-hmm. Probably the most secure form of storage would be in a vault that was owned by a publicly traded company, so that you could assure yourself that the balance sheet and the income statement of the vault owner precluded you from experiencing the risk of the vault owner stealing your gold or silver. At Battle Bank, my bank, we have insisted that our own gold and our customers' gold be stored at Brinks, precisely because we don't want them to store the gold at home, where they could experience personal security risks, but also because my memory of the 1970s was that a lot of people trusted their gold and silver to storage facilities that then either folded or stole the metal. And I don't want to experience that risk. A third thing that you could do, and I've done this in the past, is store your physical gold and silver in a safe deposit box in a depository institution where you have access to it. From a practical point of view, what I found, at least, is that it's inconvenient. In my particular case, I stored the gold in Vancouver, and I would buy it at one bank where it was cheaper and walk it down the street and deposit it in another bank, which was at once dangerous and inconvenient. Gold is heavy. And I paid the commission, both going and coming. So although I still have a fairly small amount of physical gold held in a safe deposit box, a legacy of my own laziness, I have more physical gold stored at Brinks, but I have the overwhelming proportion of my gold, silver, platinum, and palladium holdings represented by depository receipts in the form of the SPROT physical products.
Mm-hmm. Okay, got it. Yeah, that's kind of interesting. So obviously Brinks is a huge, institution, and they do. I was kind of doing some research in terms of like Brinks versus other depository vaults and such, and so
you're okay with Brinks or Loomis, frankly.
Yeah,
it's just that when Battle Bank went out to tender, Brinks provided better service to us than Loomis.
Got it.
Okay. Our hope is that eventually we will be able to store our customers' gold in any facility worldwide that's publicly traded and that adheres to the audit procedures that are insisted on by Battle Bank.
Mm-hmm. Okay, got it. So what's your perspective on? So there's obviously bullion dealers that have vaults and depositories and such, and they're insured as well. So what's kind of the risk there? I mean, I think there's risk in everything, but
I have no interest in storing my gold or silver in vaults that aren't publicly controlled.
hmm
Many of the best bullion dealers give you an option of which facility to store in. And they often emphasize vaults that they themselves have better custodial arrangements with. Meaning it might be that they charge you 50 basis points to store your gold or silver, while the vault is charging them 10 basis points, and they're making a 40 basis point spread on you. The consequence of that is that their spread is predicated on you storing your gold in a facility that isn't publicly controlled, which is to say a facility where you don't have access to the balance sheet and the income statement, where you don't understand anything about the solvency of the institution that stores your gold and silver. To me, that's an unacceptable risk. The higher quality bullion dealers worldwide will allow you the option of storing your gold or silver either as allocated or unallocated product, and they will allow you the option as to whether you take physical delivery, which I wouldn't do, or choose between the facilities that you store it in. And I would insist personally that my storage be accommodated in a facility that was publicly owned.